Welcome to my channel. I'm Scott, and in this video, I am going to walk you through the process of valuing Walgreens Boots Alliance stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Walgreens Boots Alliance is a holding company that owns the retail pharmacy chains Walgreens and Boots. It was formed in 2014 when it acquired the remaining 55% of Alliance Boots, giving it 100% ownership. Walgreens became a subsidiary of the newly created entity. Even though WBA was formed in 2014, Walgreens originally started operations in 1901. The company used to operate in three divisions. The first is Retail Pharmacy USA, which are the Walgreens and Duane Reade brands. The second division is Retail Pharmacy International, which is Boots and other international retail brands. And their third division is Pharmaceutical Wholesale, which is Alliance Healthcare. They did sell that division earlier this year. Walgreens operates the second largest pharmacy chain in the US behind CVS. It specializes in filling prescriptions, health and wellness products, health information, and photo services. It has over 9,000 stores in the US. It has administered 25 million COVID vaccinations and 9 million COVID tests. With so many millions of people passing through its locations, it is pretty likely to gain some new customers. Boots is a pharmacy chain with 4,600 retail stores across 27 countries. On January 6th of this year, it sold Alliance Healthcare to AmerisourceBergen for $6.3 billion in cash and 2 million shares of AmerisourceBergen's common stock. WBA now owns 28.4% of AmerisourceBergen's outstanding common stock. Since ABC pays a 1.5% dividend, that means WBA would receive $105 million per year in dividend payments. So that's extra cash flow in WBA's pocket. It did use part of the $6.3 billion of cash to pay down $3.3 billion of debt. Alliance Healthcare's investments in China, Italy, and Germany are not part of the sale and will stay with WBA. The company has a majority investment in IA. This state-of-the-art technology will allow its customers to use an ATM-type machine to get their prescriptions. The technology also helps manage staffing and inventory. This will drastically reduce operational costs at all its locations. On June 26, 2018, it replaced GE on the Dow Jones Industrial Index. It's also a component of the NASDAQ 100, the S&P 100, and the S&P 500 indices. The company is headquartered in Deerfield, Illinois, and was founded in 2014. It started trading as Walgreens in 1968 and can be found on the NASDAQ, Mexican Bolsa, Deutsche Börse, London Stock Exchange, Xetra, Vienna, EuroTLX, Swiss, and Sao Paulo Stock Exchange. Let's get started with the model. This is a large cap company, 43 billion market cap. They're trading at $49 a share, and they have 865 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have a ton of free cash flow. Their highest year was $7 billion, and their lowest was $4 billion. So free cash flow is the cash that's remaining after operating your business, paying all your expenses, and then investing back in your business through capital expenditures. So you can do anything you want with that excess cash. They do pay a nice dividend, and they buy back stock with that cash. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's kind of all over the place. It peaked at $5 billion, and it was $500 million in 2020. Revenue is the sales for the company, and you can see that goes up every year from $132 billion to $146 billion. And they have pretty low margins, between 0% and 4%. But when you have over $100 billion of revenue, even if your margins are in the single digits, it's still a ton of net income. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses that are directly related to generating the revenue. Payroll is a big cost of revenue for this company. And then below that is their gross profit, which is going down a little each year from $31 billion to $28.8 billion. Below that is operating expenses, and then below that is operating income. And you can see that's pretty volatile from $6 billion to $5 billion, all the way down to $1 billion, up to $3.5 billion. And the company does mention in their 10K why their expenses were so much higher in 2020. Their payroll was a lot higher because they had to staff appropriately for COVID-19 restrictions. Like they had to do more social distancing and they had to do a lot more cleaning. They also added $2 billion of expenses from prior years. So they retroactively added an impairment of goodwill onto their expenses. They did break out what years that's good for, but this is a non-cash item. So you'll see on a statement of cash flows later how they actually generated a sufficient amount of cash flow, even though they're reporting a lot lower earnings. And they paid $1 billion of interest on their debt, which is the most they've paid in a 12-month period. The bottom line of the income statement is their net income, which you can see is all over the place, $5 billion all the way down to $500 million. So you have to understand the income statement is accounting profit or loss. It's not actual cash. So sometimes look at the income statement can be a little confusing because when you see in 2020, they only had $500 million of profit, and in prior years it was much more, you would think they're struggling. But that $2 billion of retroactive goodwill really brought down their net income. This is the statement of cash flows. The top line is operating cash flow. So you can see they did generate a lot of cash flow in 2020. They reported a $500 million profit and generated pretty much the same cash flow as they did in 2019. And in 2019, they reported $4 billion of profit. That's why I like looking at the statement of cash flows. It kind of eliminates all those accounting items. The financials are like a big puzzle. If you're missing a few pieces of that puzzle, sometimes you can't really see what the picture is. But when you fill in all the blanks of the puzzle, then the picture emerges. I'm not saying the income statement is not important. You should definitely understand that. But you have to always realize some of the things on the income statement may have happened years ago, like we just talked about earlier, from that retroactive goodwill impairment. And they spend a good amount of money in CapEx each year, from $1.4 billion to $1.7 billion. Here's a breakdown of their CapEx in 2018, 19, and 20. And this says most of their CapEx is due to investments in our stores and information technology projects. That makes sense because it buys a lot of stores and their real estate is pretty expensive. So that is where a lot of the CapEx is. Plus, it does seem like they're trying to leverage technology and grow that part of the business as well. So you can see the company does use a lot of debt. It did add debt in 2018 and 19, but it paid down some debt in 2020 and the trailing 12 months. So overall, its debt load probably hasn't changed too much since 2018. And they do buy back a lot of stock. They bought back $5 billion in 2018, $4.2 billion in 2019, then $1.6 billion. So they do pay a pretty nice dividend, but another way to reward shareholders is to buy back stock. When a company buys back stock, that decreases the shares outstanding, making your shares more valuable. And they're able to do all this because they have so much free cash flow remaining each year, so they could pay a nice dividend, buy back stock, and invest back into their business. So if you wanted to know how a company was doing historically since it started its operations, you can't just look at the income statement for 1 year. You can look at all their income statements, but that would take forever and would be really confusing. Just look at the equity section of their balance sheet. They have $22 billion of equity, and they raised $11 billion from selling their business. And when you sell your common stock, you are selling part of your business. And then it took that $11 billion from selling stock, and it generated $35 billion of profit. And this $35 billion is after all the dividend payments. They also bought back $21 billion of their own stock. So when a company buys back stock, it keeps it on the balance sheet as treasury stock. And treasury stock is a contra equity account, so it acts the opposite of a regular equity account. If you sum up all these dollar amounts, it doesn't equal $22 billion. You would have to sum up all these dollar amounts, but not treasury stock. You'd have to minus treasury stock, and then you get your $22 billion. Let's look at the capital structure. They have $22 billion of equity, $40 billion of debt. They're 36% equity, 64% debt. And their weighted average cost of capital, which is a blend of the cost of equity and cost of debt, is 6.89%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year for. That's $158 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $143 billion. We divide that by 865 million shares. And we get a calculated stock price of 165. They're trading at 49, so they're trading at a 70% discount. It's a really strong buy according to the model. The way I estimated their future free cash flows, I just used my model to calculate it. And let me know in the comments if you want to see that video where I show you how to calculate the future free cash flows using the model. I'm able to calculate their future free cash flows with a company like this because it has positive and pretty consistent numbers. You can't really calculate future free cash flows if the company has negative free cash flows in the past. So you have to do more digging and analysis and try to come up with an estimation yourself. Simply, Wall Street values the company at $122 a share. They're saying it's 60% undervalued. 10 analysts priced this stock and the average price target was $55. This is where the stock has been trading since '84 when it was Walgreens. It did peak around $90 a share, but it came down since then. It hit a pretty low point in March 2020, but it has come up since then. It was in the low 30s. But it still seems like it's trading at a major discount since the company is so profitable. This is the stock price in the last 12 months. So it was coming up a lot for several straight months, but it seems to be regressing. I just don't understand why investors aren't blowing this stock up. There's companies that aren't even making money that their stock prices are going way higher, and this stock price is just trading sideways. And they do pay a nice dividend, 3.8%, and they raise their dividend each year from 38 cents up to 47 cents. To calculate the dividend yield, just multiply the last dividend payment by 4, then divide that number by the stock price. And they pay out 71% of their net income, 32% of their free cash flow. So they do have a lot of cash left over to maintain that dividend payment or even grow it, or buy back stock, which is what they're doing right now. And they have a pretty low beta, 0.47, so the stock doesn't move too much. It moves half what the market moves. The stock is lagging the S&P 500 up 21%, the S&P up 32% in the past 52 weeks. The 52-week low is 33, the high is 57, and the stock is trading between its 50-day and 200-day moving average. When a stock trades between these two numbers, it generally means it's trading sideways for a while. And their industry pays a 1.5% dividend. They're more than double their industry. And analysts are forecasting their dividend to grow to 4% in the next 3 years. 5 to 6 million shares are traded on average each day. Of the 865 million shares outstanding, 716 million are on float, 58% are held by institutions, and under 2% of the shares are shorted. The stock has done okay in the past year, but it's down a lot the past 3 years and 5 years. Analysts are expecting their earnings to grow 22%, their revenue to grow 3%. In the past 5 years, their annual earnings decreased on average 22%, but in the past year it increased over 300%. They must be comparing 2020 to the trailing 12 months. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $17,000 today. Not the best return, but it's still a decent return, 5.5% annual return. Their biggest shareholder owns 17% of their stock, then Vanguard, BlackRock, State Street, and Capital Research. Let's look at their financial ratios. They have a pretty good PE ratio at 19. That's better than the market median and average. They have an amazing price to sales ratio of 0.3. So they bring in a ton of revenue. They don't convert that much revenue to net income, but they're still converting enough to have a good PE ratio. And their price to book is also pretty good at 1.9. Price to book is stock price over book value per share. To calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities. And they have $22 billion of equity, but since they have $23 billion of intangible assets, they actually have negative tangible book value. Their return on invested capital is a little low at 5%. So even though they have a lot of debt, I would just look at the interest coverage ratio. They can cover their interest payments 3.5 times. And I know some people may say, what if interest rates go up? Or what if sales go down? Pretty much any company can go bankrupt if you keep changing around scenarios. But this is such a big company. I just cannot imagine all the millions and millions of people that go to their businesses moving over to another company like CVS. So it seems like a pretty stable investment if you ask me. They have a really good ROE at 10%. A good way to inflate your ROE is to add a lot of debt. And their current ratio and quick ratio are below 1. But companies that have tons of cash rolling in sometimes have a quick ratio and current ratio below 1 because they don't need to sit on a lot of cash because they know they can just wait a week or two and then another $1 billion of cash comes in. The best way to look at ratios is to compare them to companies in the same industry. According to Yahoo Finance, these 3 companies were in the same industry as WBA. So WBA is better in every single category except current ratio and debt. So to summarize, I have them trading at a 70% discount, and I've been saying for over a year how this stock is severely undervalued. But a stock price will not go up unless other investors feel the same way. People love stocks like Tesla. Even before Tesla was making money, it's just a hot new craze. So it's kind of sad a company like this that is so stable and strong can't get the love Tesla does. So you can find a stock that's really undervalued, that's generating lots of cash and is really profitable, but for some reason, people just don't see that. They're looking for flaws. They may say too much debt or too much competition or something else, and they just won't buy the stock. At least you get that stable dividend payment, but you never know. Things can change anytime in the stock market. That's the exciting part of investing. I rank their free cash flow as 9 out of 10, their revenue 10 out of 10, and their ratio is 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.